think, act, and prosper. You are now tuned into the Money Level Show.
Hey, Alasdair, glad to have you back on the show.
Daryl, it's very much my pleasure.
Yes. So I want to get your updated assessment. We are in Q2 of 2024, and I want to just see what's your current assessment and what are you seeing on the fronts of the economy and markets.
Oh, well, there's a lot going on and there's a lot that's wrong. I think the thing that's really wrong is interest rate expectations. It's expected that interest rates will decline. People are behaving as if the sort of, if you like, the Keynesian paradigm, which they've got used to, and they know no other, as if it's valid. And basically, it is not. The problem is that when you get a restriction on credit, or when you get an excess of debt being issued over the available buyers, then interest rates rise, bond yields rise. Banks are not lending widely. Banks are being incredibly selective about lending. Why? Because their balance sheets are over leveraged and they are trying to reduce their risk. Where they are lending is they're lending to the government, and they're lending very short term. The money that the government is borrowing tends to be in the order of T-bills of, say, 3-6 months, probably at the outside about a year. On top of that, of course, governments do manage to do a little bit of funding along the yield curve. Why? Because they're pension funds and insurance companies that need to have term debt. But that's about it. The US government is going to have huge problems funding its deficit. Most people think that the deficit this year will be in the order of $2 trillion, and that comes from looking at the CBO's estimates. They're wrong. They're widely wrong. I think it's going to be closer to 3 trillion. I'm talking about a year of presidential elections. I'm talking about a year when interest rates are going to rise or borrowing costs are going to rise. I'm talking about a year when the Chinese are net sellers. They're not buyers. Now, this is important because the Chinese have been the largest identifiable buyer of US treasuries for some considerable time. It's true that Japanese are shown as owning more treasuries than the Chinese, but it's not the Japanese government that owns them. It is spread around insurance companies, pension funds, and also it's spread around the the traders who do the carry trade. So that, if you like, is the Japanese interest. But in China, it's the government. It's not insurance companies, pension funds. They have exchange controls. And this is why Janet Yellen has been over to talk to the Chinese twice in a year, though it doesn't seem to appear on any schedule, I suppose for an obvious reason, because they don't want to frighten the public. This is why Treasury officials are liaising with the Chinese regularly. The whole situation as far as funding US government debt is very, very dangerous. Foreigners realize this, and they will increasingly turn sellers of US treasuries and also the dollar. And this is why the gold price is rising. I mean, it won't have escaped many people's notice, I guess, that the old relationship, which was written in stone, that higher interest rates is bad for gold, seems to have changed. And it's changed for exactly the same reason that expectations about falling interest rates are completely wrong. This is a sort of Keynesian idea, which actually has got nothing to do with market reality. And the point about market reality is that it is markets which are driving things now, not the Fed. The Fed is not in control of interest rates. In fact, I saw something the other day to the extent that the Fed is extremely concerned about the funding outlook. Admittedly, it was a non-Fed source. I think it was an article I saw on the Mises Institute's blog. But this is interesting because I think increasingly people will understand the funding difficulties which the Fed faces and realize the Fed is not in control of interest rates. As soon as you grasp that, you realize that markets are horribly mispriced. You will see bond yields rise, which means that bonds fall. You will see the gap between the valuation in bonds and the valuation in equities widen, which will basically bring equities down. It's bound to happen. So we're at a point of, I think, an inflection point, really, Daryl, and I think it's a very important time. So that's Q2 summary for you.
Yes, yes, that's pretty loaded. One thing you mentioned the expectation of interest rates, and I haven't fully studied the history or the cycles of interest rates, but I know that we've been in a 40-year decline in interest rates, and then to have that expectation that interest rates are going to continue to go lower instead of higher, seems unreasonable. Could you speak to the historical cycles of interest rates and how people who have this expectation are getting it wrong?
Yeah, you said the last 40 years. That's about right. Really, every time there has been a recession or a financial panic over the last 40 years, the Fed has managed to step in and muscle interest rates lower. Interest rates have effectively been suppressed ever since the mid 1980s, when the banking system was financialized. They moved away from lending to business, lending to production, more to lending, tying up their balance sheet for financial activities. That was really what Big Bang in London was all about. And it forced the change in the Glass-Steagall Act eventually, which I think was in the early 90s in America. But basically, the Fed was able to muscle interest rates down really against a background of two factors. Firstly, inflation didn't appear to be a problem. If anything, it was a declining problem. And admittedly, they were running the figures and they were manipulating the figures, but put that to one side. I think it was still true to say that the idea that a lower interest rate would stimulate inflation proved generally not to be apparently the case. That's the first thing. The second thing is that it was against a background of lower government debt to GDP than we have today. Early in the 1980s, we were looking, I guess, at debt to GDP for America in the region of what, I don't know, 25, 30%, maybe 35. I don't have the figures on the top of my head. Today, we're looking at a rate of about 130%. The idea that with a combination of inflation, which is now rising, in other words, the purchasing power of the dollar is declining, and at the same time increasing the amount of borrowing, you can't do it. It's not going to happen. But markets are priced on the basis of every investment manager's experience. They haven't experienced this before. You get a few people who are old like me, maybe, who say, this looks like stagflation. The stagflation of the 70s has returned. That's probably a reasonable description, but I would suggest it's worse than that. We're looking at a situation which, combined with geopolitics, looks likely to lead to the end of the fiat currency era. And that has enormous implications for everyone's values because your wealth is measured in credit. If it's the end of the fiat currency era, fiat currency is a credit. Then the value of portfolios, the value of that credit is going to decline, and it could decline catastrophically. That's roughly where we are. These are very important times.
Mm-hmm. Yeah, yeah. The fiat is credit. Gold is money. Everything else is credit, right? So I was wondering about. So we have these unfunded liabilities. I mean, 210 over $200 trillion, and from the research that I've done in the at least in the United States in the mid early 30s, that Social Security fund is supposed to be dwindling down significantly, where there's going to be cuts. And I kind of wonder about the tax implications because like they have to get the money from somewhere. Um, usually I think throughout history, like when there was either a war or when there was either some type of massive production discovery that could bring some significant amount of wealth, it could help fund some government spending. But right now, I'm just wondering, like, what is the tax implications on average citizens, especially considering that historical tax rates were significantly higher than where they are today. Like, how are they going to get this funded? Time out. Quick break in the action. This message is brought to you by the Rule Symposium. This annual symposium is hosted by the legendary investor Rick Rule himself. It will take place from July 7th through 11th in Boca Raton, Florida. Mr. Rule invites some of the most brilliant minds in macroeconomics and natural resource investing. This year, featured speakers include Danielle DiMartino Booth, Nomi Prinz, Jim Rickards, Grant Williams, Lobo Tigre, and more. Rick even organizes the Living Legends panel, where he invites individuals who have built billion-dollar businesses from scratch. Attendees will be introduced to a myriad of companies active in the natural resources space, with the companies invited being the ones that Rick Rule invests in himself. The symposium is held at the Boca Raton, which is an amazing resort with exceptional amenities. I attended in 2023 and thoroughly enjoyed my time there. I went on an amazing cruise with Rick and other investors and CEOs of companies, and even had the opportunity to test drive an Aston Martin for the first time. So don't miss out on this opportunity to have fun and receive high quality education to help secure your financial future. Click the link below to sign up, and I promise you won't regret it. But if you do, Rick offers an amazing money back guarantee. So what are you waiting for? Click the link below to sign up today. Now, without further ado, let's get back to the content.
Well, I think that's an interesting point. I mean, we can't afford the governments that we have. It's actually as simple as that. And this is the point behind these unfunded liabilities that you've brought up. I think that this is going to be an increasing problem. One thing it does is it really calls a lie to the idea that governments can inflate their way out of a problem. When people look at existing debt and think, well, if the purchasing power of the dollar goes down, then in real terms, it's going to cost less for the government to pay it off. Yeah, well, that's great. But actually what happens is that those unfunded liabilities become a lot more expensive the more the dollar goes down. So there is actually no way for governments out of this dilemma. The only way they can deal with it, the only way they can make the books balance, is for the Fed to indulge in massive QE, because they're not going to find buyers for this debt in the private sector. The only way in which this debt will be bought is through the money being printed to buy the debt. That's the way it works. I mean, this is what QE was all about. The idea that the Fed can just print money actually doesn't work. They have to print it for something, because you've got a balance sheet, which has got assets and liabilities. All our lives run on balance sheets, assets and liabilities. So if they print the money, they must print the money to buy the debt, and they print the money to buy the debt, and the government then spends it. It then goes into the economy. It makes GDP perhaps look excellent from a nominal point of view, but actually it's all false, completely false. And I would say that people who look at the US economy and think it's being remarkably buoyant in terms of GDP are not taking into account that the only reason that is the case is because of excessive government spending. It's not productive spending, and the debt behind it is not productive either. And it's just becoming an increasing burden on the whole system. And your point about the unfunded liabilities, as they come home to roost, that position is just going to get worse and worse and worse. I mean, the fact of the matter is that the US government, along with various others, is now in a debt trap. The only escape from a debt trap is to stop spending, change laws so that you can stop spending, because most governments have laws which commit them to, say, spending on health, spending on unemployment, spending on welfare of different sorts, spending on defense. I mean, you need a good old-fashioned company doctor as president or prime minister or whatever, with a mandate to deal with the problem, rather like Milei in Argentina, and to understand what he's doing and really cut back on everything. I see no chance of that happening, particularly in an election year for the new president, when really, and also, I mean, you look at the bills that go through Congress. The only way they get passed through Congress is because the other side, as it were, call it the Republicans, in order to get to support the bill, they want their bit. They want their interest to be satisfied as well. So a bill which, let's say, starts out at $1 billion ends up at $1.5 billion. This is the reality of our democracy. It is destroying itself, and there is no discipline on governments to stop doing that. And this was the whole point behind, if you like, having the credit backed by gold, having the currency backed by gold. A gold standard was a discipline on governments. So we have now had just over 50 years of the complete lack of this discipline. And it's not surprising that we've ended up where we are. We are bust, basically. The banking system is bust. Just look at the Fed's balance sheet realistically. The losses on that balance sheet are enormous and increasing every time there's a rise in the bond yields. So, and they are if you like, meant to be, along with the US Treasury, the engine for guaranteeing the solvency of the commercial banking network. And we've already seen a few banks go belly up in the regions. I mean, there's going to be more of that. And if you think that the problem is confined to America, you are wrong. I mean, to look at the situation for the Bank of Japan. Bank of Japan fully owns 60% of the Japanese government's debt. 60%, 60. It's been doing QE really since the year 2000, probably a bit earlier. Look at the ECB. The ECB, again, has huge, great losses. And those losses are also spread around the network of national central banks. Now, to recapitalize that system is incredibly complex, and it's not going to happen. And we're looking at two banking systems between Japan and the Eurozone, where the major GSIBs, the global systemically important banks, have asset to equity ratios in the order of 20 times. That leverage is enormous, and that leverage came about because of negative interest rates. The only way in which a bank could satisfy its shareholders growing its profits was by increasing its leverage as the margins in credit margins were compressed. That was the effect of negative interest rates. And now, of course, interest rates are rising. I mean, in Japan, they're threatening to break through 1%. 1%, my goodness. I was looking at the relationship between the Bank of Japan's asset values, as it were, adjusted for market values, and equity. And equity was wiped out something like 400,000 times. Would you believe it? I mean, the whole thing, Daryl, is a most extraordinary mess. It really is. And here we are, we've got the summer and it's nice, the sun's out, and we're not worried about these things. Gold is going up. Well, it's lovely for us gold bugs. Why is it going up? Oh, I don't know. We'll just spend a bit more time on holiday. We'll worry about that later. I tell you, there is an awful lot of complacency in markets at the moment, and I would describe them as completely complacent, really. This is not a good situation. This is a situation which will correct. When it corrects, I think the correction will be vast, very, very big, and it could be almost total very, very quickly. I mean, this is not something which I can see having a gradual decline. The if you like, the move away from reality has become so marked that any correction towards realism is going to be so substantial. It's going to be a real crisis for businesses, for banks, for governments. And this is why the Chinese, I mean, even the Chinese are rushing out and they're putting the squeeze on us in the gold market. Well, it's hardly surprising when you see the buildup of savings in China, when you see how the individuals in China have been turned off property. Not only are they turned off property, but the stock market this year has gone up 7% or something. And they have the memories of the last 3 years where it declined very substantially. So they're not buying that. They're putting money on deposit. They're buying what's called CDs, which are certificates of deposit, which give them a 3-year, but 3% interest rate return. And they're buying gold. And they're doing this through various channels. So, and that demand has only just started. I mean, we think that perhaps it'll stop soon. No, it's only just starting because they're certainly not putting their money anywhere else.
Mm. Yes, a lot of great points there. So one thing I hear you saying is politicians have been able to kick the can down the road for a while, and now backs are against the wall. And there isn't very many options. I mean, the only option is for a correction towards realism, which is going to be painful, right?
Yeah.
And then also the price of gold, measured in dollars, going up, and the dollar falling against gold isn't necessarily a good thing. Like it's what I've been hearing. Like some people look at gold as an insurance. Some people look at it as a hedge against crisis. Obviously, people look at it as money, right? And when gold is rising significantly, it seems like there's chaos in other areas of economies and markets and finance and such. And so is that a correct assessment?
I think it is a correct assessment generally, yes. I mean, but above anything else, gold is money and the rest is credit. I mean, we were talking about this off air before we started this interview. And of course, governments deny it. Governments reckon that gold is no longer part of the monetary system. They don't really have an answer as to why various central banks retain their gold holdings, though if you talk to central bankers, they do actually understand that it's nobody else's liability and it has a unique value as that. They don't necessarily say that gold is money as such, but they do recognize that role. But if you go to the Far East and talk to the Chinese, I mean, basically what the People's Bank is doing is it's selling dollars. It's not buying gold, it's selling dollars. That's the way to look at it. And it's in effect, through its actions, it's telling all the savers in China to do the same. And the savers in China, I mean, you're talking about 35% of a GDP of roughly $18 trillion equivalent. That is the amount that's put aside every year in the form of savings. I mean, that's around about $6 trillion. Now, where's that $6 trillion going to go? As I say, it's not going into property. That was yesterday's story. It's not going to the stock market. That was yesterday's story. It goes on bank deposit, but you can see that bank deposits will pay you 3% or something like that. Then there's this new game in town. This is being led, if you like, by the People's Bank. They're selling dollars. Now, that's official policy. Okay, that's fine. But also, this is something we can really make money on. You can see the driver, if you like. Now, we're looking at $6 trillion equivalent accumulating year in, year out in savers' hands. Well, I'm talking household savers. This is important to understand. Household savings, 6 trillion. That's what? That's the equivalent of about 8,000 tons, I think, of gold. No, it's more. I don't know anyway. They're huge figures, huge figures. I mean, if they just put 10% of that, it just cleans us all out. the way this is going, I mean, the way the Chinese like to punt things that are rising, and they can do this. I mean, all the banks offer gold accounts. So you can literally, with a minimum of around about 500 yuan, you can open a gold account. So, you've immediately got access to buying gold. As well as that, people have got apps for dealing in gold on their mobile phones. And of course, you can go into the local store and buy, jewelry, 24-carat jewelry, and ingots, and all the rest of it. And that again is a huge, great demand. And routinely these shops run out of stock, so you can see what's happening. And of course, it's caught the Western capital markets wrong-footed, completely wrong-footed. And you have a lot of people who say, well, the Chinese are really speculating. Yeah, they do speculate. But if you think they're speculating on an uninformed basis, I think you'd be making a huge mistake. And the idea that this speculation is going to go away after it's risen a certain amount, or you get a decent shakeout and then it's a different story. I mean, this is, the triumph of hope over experience. It really is.
Mm. Yeah, that's I mean, just the amount of gold buying in China is very significant, and I've been seeking to understand that more. And I saw an article back in 2010 when we were going through the global financial crisis, and China had come out and told their citizens to buy gold. And so that was pretty telling there. And then right now we have a huge amount of gold buyers, that are people that are selling dollars to buy gold over in China, and that just like I can see how the difference between the COMEX and the Shanghai. 'Cause I think the Shanghai has more of a premium. Is that the difference? Yeah. And so
Yeah,
I've been looking at
yeah.
that.
No, that's right. The difference between the time which you were referred to is that now the Chinese government are not advertising buying gold. This is something happening. It's being driven, if you like, by Saber's demand, and is something which, quite frankly, I think could get out of control. And I mean, on its own, I think it could easily destabilize fiat currencies. Yeah, and if you look at how gold has performed in yuan, I mean, I put together a chart this morning for an article which will be released on Thursday on my Substack channel. I can see that in real terms, priced in yuan, gold has moved along a pretty normal track. I mean, obviously, in nominal terms, it's been very volatile and it's been absolutely fantastic. You look at the chart, it just goes up and up and up, and there's the odd move down, and then it shoots up. But if you use a logarithmic scale, in other words, you actually look in real terms, then it's moved along a pretty well-defined line, and it hasn't yet really taken off. And I think the message from that is that, first of all, it is not overvalued in yuan terms. And the second is that the real run in the price is yet to happen. Interesting situation. And of course, you've got silver on the back of it too, and that's being caught in a difficult position as far as users of silver are concerned, because it's basically an industrial metal nowadays. It obviously has overtones of moneyness in it. And the move in the price of gold tends to be accompanied by a move in the price of silver. They correlate very well, with the silver's move being roughly twice as much as gold. In quiet times, silver tends to drift lower, and that's how we got to a position of a gold-silver ratio a few years back of 120 times. Recently, it's been trading, the gold-silver ratio has been trading between about 80 and 90, but on this move, it's broken down, and we're now looking at 76.5. I think that's going to go lower. I can see silver. I mean, silver on the charts just looks absolutely fantastic. And I think, there's an explanation for it, and that is that, stocks in the vaults have reduced quite significantly, both on COMEX and also in London. The industrial demand is accelerating. India is now getting into the photovoltaic cell manufacturing business. And so Indian corporations are buying silver. And I think they have taken delivery of a lot of the silver, which has been stood for delivery on COMEX. So, putting it all together, the last thing anyone in the silver, in terms of, if you like, the industrial users of silver want to see are the investors coming back in and actually buying silver. They're not in the West, just like gold. I mean, none of this buying of gold is in the West. The moment they start coming in, then that is going to create a real crisis in the silver market. It's just going to drive the prices far higher. And I think the combination of similar circumstances in gold actually could destabilize the bullion banking community, who are all short one way or the other. So this is it's going to be interesting times. They will have, if you like, a religious moment. Put it that way.
Definitely. So I was reading an article you shared earlier about the silver uh, potentially heading over $50 an ounce, and right now we're at that. The breakout is the 31 to 32 price. So I was checking that article out earlier today. Um, like how high could you see the silver price go? Like based on what the charts are saying.
Well, there's an old-fashioned statement in the markets which covers this. It's bid only. In other words, the upside is whatever you want to dream it. Um, and I'm not in the business of forecasting prices, really. I just try and analyze the current situation. I don't sort of have price targets, which I know lots of brokers, researchers do. Um, but I think that you should be aware, and people should be aware of the dynamics driving the price. And this is something that's not going to stop soon because there isn't the stock available. There has been an accumulation of stock over the years. If you read the forecasts and the records of the Silver Institute, but I think quite a lot of that has been stockpiling silver, and I think that China in particular has been stockpiling silver. So what do they do with this stockpile? I mean, they see the price rise. Do they do what the Americans have been doing with gold over the decades? When you see gold going up, it's a bit embarrassing. So what you do is you sell a bit in the market and try and drive the price down. No, they don't. They need that silver. They're not going to part with it. I can't see anyone who has accumulated stockpiles of silver selling into this market to try and suppress the price because they know they'll lose it. They won't come back. They don't want to get into the situation where the Americans are in, with the US Treasury having sold gold. There is no doubt that the US Treasury does not have the gold it claims to have. I mean, if you want evidence of that, then look at what happened. When Germany demanded a small part of their gold earmarked as their property at the New York Fed. And when they demanded that back, that's very difficult. We can't possibly do that. We're going to need at least 7 years' notice. Was what came back. I mean, it's just ridiculous. It was quite clear that they'd flogged that gold on and they just didn't have it. And any pictures of, vaults full of gold. And incidentally, they denied the Bundesbank representatives. They didn't give them permission they denied permission for the Bundesbank's representatives to go and look at the vaults and inspect their own property. I mean, why? It's not there. It's quite simple. Now, contrast that in this situation with China, which has been accumulating gold off balance sheet, if I can put it that way, certainly since the People's Bank was appointed by law with the responsibility to manage the nation's or the state's gold. back in 1983. I reckon they've got over 30,000 tons now hidden. And this is apart from what they actually show on their balance sheet as reserves. Russia is a similar situation. Russia has a certain amount of gold on the balance sheet of the central bank, but they've got two further funds which are believed to hold a further 10,000 tons. Now, we can't verify that, but I talk to people who are well informed in these matters, if I can put it that way, and that's the figure which keeps on coming up. So, I mean, and that means that Russia has got more gold than America officially says it has. Now, we know officially, we can be damn certain officially that America hasn't got that gold. So, this is a situation where, the king rat of fiat currencies is completely unprotected. And the currencies of its two main enemies, hegemons, whatever you like to call them, is well protected and can be revealed at any moment of their choosing. They do actually have it in their power to destroy the dollar. And, that brings us on to the topic of geopolitics. When it comes to the wars in Ukraine, when it comes to the potential conflict, the problems in the Middle East, drawing in the superpowers, when it comes to saber rattling by America over Taiwan, and all these factors, actually, just by putting their currencies onto a credible gold standard, Russia could just kill the dollar overnight, just like that, which is an interesting thought. And the only thing I would say, I think it would be a good thing because we need to get back to reality. But for those who do not want to face the consequences of that, I would say, well, it at least is better than a nuclear war. A financial war is better than a nuclear war. And I think that's probably how it's going to end up. I hope it ends up that way because the alternative is we seem to be sliding into just greater and greater conflict.
Mm-hmm. Yeah, agreed. So with I wanted to transition a little bit to the equities, like the gold, silver miners and such. Um, when there's lack of supply, people are buying gold and silver hand over fist. And I wonder at some point, will that transition to equities? Do you have any particular thoughts there?
Yeah, it is transitioning, Daryl. That's already happening. It's very early days. It's an interesting time because it's been so long since gold, silver, and other commodities really were worthwhile as far as the brokerage community is concerned in terms of coverage, research coverage. Spending money on research is not necessarily a cheap thing. What they have done is they've concentrated more on, tech stocks and all the rest of it. That's where the money is being made. That's where the investment banking profits are. It hasn't been in the dirty business of mining. And furthermore, in recent years, the whole of this sort of environmental, anti-fossil fuel, ESG movement has worked against the mining industry. So the brokerage industry basically has not invested in research. So in these very early days, what you're seeing is the beginning of a shift, if you like, of portfolio allocation away from the fashionable, the tech stocks and all the rest of it, into what's likely to be the newly fashionable, which obviously gold, silver, copper, all the miners, if you like, of these vital goods. And it's going to take time for the brokers to build up a research capability covering the sector. So what we see now is they're just literally going in and buying the big names. What they're finding is that you want to go in and buy a big line of stock of Newmont Mining or something like that. There isn't the stock available because it's become so tightly held that there are no sellers. You've got to have sellers on the other side to satisfy the buyers. And what this means is that the whole sector is completely mispriced. It's got to rise significantly in order to generate the sellers to satisfy the new buyers. And so I would see the sector moving up on very little volume. And then you will find that people will start putting more effort into research. And you'll find that the long-term experts who have been in this game, in the mining game for a long time, their expertise will become sought. It'll become extremely valuable. I see those guys actually doing very, very well. I'm no longer in that business, but as a long-term observer, I've seen these shifts over the last 50 years, not just between sort of mainstream industrials and mines, but also between others, different sectors. I've seen brokers who recognize value getting into an undervalued sector, being patient for 2 or 3 years before that starts to really pay off. But these are the guys who really make money. These are the guys, the value, the guys who go for value and understand what they're doing. They're the guys who really make money. Whereas the momentum boys are going to be chopped off at the knees. They really are. It will be rising interest rates that does it on the one hand, and the fact that they know absolutely nothing about mining, and they're going to have to pay up in order to buy it, and they'll probably end up buying the wrong stuff anyway. So it's going to be interesting times for those who are on a learning curve. Let us put it that way. So good topic to raise, I would say.
Yes, for sure. I mean, especially, for me and my audience, we buy gold, we buy silver, but we also invest in natural resources and just looking at, the whole AI craze and everyone's talking about AI, and then we're looking.
Yeah.
I did some research on seeing that Amazon and Microsoft have been investing in nuclear power plants and so, just even having uranium and all of that, like, it's like, hey, we need these resources to even drive these ambitions or these dreams on the other side of it. So it's definitely been a long time coming for more people. I haven't been in it too long, but for more other people that have been in it a long time, it's been a long time coming.
Yeah, sure.
Well, Alasdair, thank you for coming on again. So you have a Substack and you have a Twitter. Where can people find you at?
Yeah, Macleod Finance on Twitter, or at Macleod Finance, and also my Substack is Macleod Finance Substack. So that is the brand, as it were. For anyone who really wants to follow the ins and outs of what's going on in precious metals, the geopolitics, the understanding the relationship between money and credit, and pure economics, as well as market commentary, become a paid subscriber. I strongly recommend it, but then I would.
Yes, definitely. Be sure to go support Alasdair at the Substack. I mean, and you're also getting an extreme amount of value. I mean, we just scratched the surface with this interview. He goes in a lot more detail and depth in his writings and everything. So thank you, Alasdair, for coming on.
My pleasure, Daryl. Thank you very much for having me.